Well, the most recent memorable time in the markets, and I think it's fresh in every trader's mind, was the SNB event in January, which was a crazy, crazy event. Things like this have happened before, but when you get a big jump in a price, you expect maybe 300 pips or maybe 5% move in a day, then that's extraordinary. But what happened on that day is about a 30% move down in Euro Swiss and about a 20% move down in Dollar Swiss, which is just extraordinary and unfortunately very, very damaging for anyone that was long, that bought in those pairs. Not just damaging for the trader, also damaging for the brokers. Now, this is a very interesting situation, and it was brought about by the SNB themselves, which is the Central Bank of Switzerland. They created an artificial floor in euro to Swiss franc, and they held that floor for years. Now, they told the market, we're going to protect this floor at 1.2, and it's not going to go any lower. And they did that because they didn't want their currency, the Swiss franc, to get too strong or stronger against the euro, because they do a lot of trade there. And they export a lot, Switzerland. So if their currency is too strong, it means that there's potentially less exporting going on. And the SNB have spent a lot of money, so sold a lot of Swiss francs to keep their currency weak and keep it at this level. Now, what happened over time, everyone saw this 1.2 level, and occasionally it would move to 1.21, or we'd see small spikes up, and people wanted to take advantage of these smaller moves up. So we saw a lot of individual traders and maybe some big companies as well, so hedge funds, for example, putting trades on at the 1.2 level, buying at the 1.2 level, thinking the SNB are going to hold it there. They've told everyone it's going to stay there, so my risk here is nothing. And on that day in January, the SNB announced with no warning, in fact, a few days before they had even reassured that they're going to keep that level, they announced no warning that they're not going to do it anymore. So of course, the markets panicked hugely. So you got everyone in the world wondering, where the hell do we price this? Where the hell are we buying and selling? So you have sort of a chain of traders in a way. You obviously have the big investment banks that are dealing with the big institutional investors, big private clients, and the investment banks are also trading with each other. Some of these investment banks are Swiss, by the way. Then you have brokers that normally look after private clients, let's say in the FX market, and brokers are trading with the investment bank. They're taking your position and they're putting it with a bank, for example. And then obviously you have the individual trader that's trading with the broker. So what happened in that instance is that traders were trying to get out of their position, I assume, so sell or close their position in Euro Swiss because they saw that they were losing a lot of money. Brokers were trying to replicate that trade with the banks. The banks weren't giving any prices for this pair. There was no price, there was no tradable price, and because they didn't know where to price it. The market was going crazy. Some people were buying at 0.86, from 1.2 to 0.86. Some people were buying in between or selling in between. It was all over the place. So it created this havoc. And 30% move in a price. If you were 100,000 long, so you bought 100,000 Euro Swiss at that time, then you would have potentially lost about 30,000 euros. Bear in mind that on 100,000 on a standard account, 1 to 200 leverage, you're just putting 500 euros into that. So the difference between 500 euros and 30,000 euros is huge. Highly unlikely if you're just trading a position where you normally only have to put 500 euros into it. Highly unlikely you're even going to have 30,000 in your account. So when it moved down to this lower price, and that's the first price that you can get out of the trade, it's the first tradable price in the market, you see that you've got a deficit of 30,000 in your account. And some brokers also would have had that deficit in their account as well, because they're trading with a bank, they're replicating your trade. And if you are unable to pay the broker that deficit, that negative balance of your account, it means but the broker has to pay the bank. There's no way of getting out of an investment bank, you have to pay them. So that's why you saw some brokers going bust, also with hedge funds as well. You saw a few sort of larger entities going bust because their clients couldn't afford to pay the debts on their account, and hence they had to pay the debt to the investment bank, and they couldn't. And as a company, you have to, in that situation, you have to fold and collapse. There's actually not a lot you can do in that situation. I mean, a lot of people would have had stop loss orders on, but a stop loss doesn't matter in that market because there's no a stop loss can only be executed if there's a tradable price. If there's no tradable price and a gap, so it dropped from 1.2 to 0.9, and that there's no price and no one's willing to buy or sell in between those levels, then there's no way a stop loss can be triggered. A stop loss will only be triggered at the best possible price that's tradable, that comes after your level. And in this instance, that was 30% lower than where you placed it. So stop loss wouldn't have even helped in that situation. Now, what I can tell you is that if people had been buying options at the time of the Euro Swiss, then this disaster wouldn't have happened, because when you buy an option, there is no stop loss, and the most you can lose is the fee that you paid for the option. So actually, we saw traders buying options in Euro Swiss at the time, and that option allowed them to reserve a buy rate at 1.2 in Euro Swiss. So if Euro Swiss had gone up, as everyone expected to, take advantage of these small moves up, then the option would have paid out. But in this situation, a trader bought 100,000 Euro Swiss option, paid 250 euros for that option. That's it, that's the fee. And so when it moved against him, he lost his 250 euros. And when you compare 250 euro loss, compare with a 30,000 loss, which is comparing the direct trade in the underlying with the option trade, it's a big difference. And it shows that how options can be used in that sort of scenario where an outcome is unknown or when high volatility is potentially on the cards.